So let's talk about Bitcoin. It all started with this big dream, right? A totally decentralized network run by the people for the people. But today, well, it's a massive industrial scale business run by giants. So the big question we're tackling here is, with all the crazy economic and tech pressures, is there any way back to that original dream? Or is the very idea of decentralization about to change into something completely new? All right, so here's how we're going to break this all down. We'll kick things off with Satoshi's original vision. Then we'll get into the brutal economics that led to this massive consolidation. We'll even look at some forces that might be surprisingly pushing it apart again. And then we hit the huge twist in the story, the AI pivot. Finally, we'll see how all of this makes us ask a totally different question.
To really get where we are now, we've got to go back to the beginning, to that simple but pretty revolutionary idea behind Bitcoin itself.
This was the whole point. The security of the network wasn't supposed to be in the hands of a few giant corporations. Nope. It was meant to be spread out across thousands, maybe even millions, of regular people just running software on their home computers. A true peer-to-peer system.
But you know how these things go. That idealistic vision didn't last very long. As Bitcoin started to get more valuable, a kind of technological and economic arms race kicked off. Hobbyists with their laptops were pretty quickly replaced by huge operations with specialized hardware, and that changed the game forever. And that shift, it created a brutal new reality for anyone trying to compete.
Yeah, mining today is definitely not a hobby. It's a high-stakes business with one simple, ruthless rule: survival of the fittest. And there's one specific event that basically dictates the rules of this whole game. At its heart, the halving is just Bitcoin's built-in way of creating scarcity. But if you're a miner, it's an economic earthquake. Imagine your main source of income getting chopped in half, literally overnight. It sends this recurring shockwave through the industry that forces everyone to either adapt or go out of business. And you can see the impact right here in this number. The hash price, which is basically how much a miner makes per unit of computing power each day, it just fell off a cliff after the 2024 halving. It pushed miners into what one source called the harshest margin environment of all time. And the result of that? A massive shakeout. In just the first half of 2025, the number of small and medium-sized farms dropped by 18%. They just couldn't make the numbers work. Meanwhile, the biggest farms, the ones who could get cheaper power and better gear, they actually grew by 12%. So this survival of the fittest environment directly paved the way for a new kind of Bitcoin miner. These massive, publicly traded corporations that operate on an incredible scale. In this new industrial age of mining, you either go big or you go home. The whole game is about squeezing every last fraction of a penny out of your operation. And really, only the biggest players can get the economies of scale they need to lock in super cheap power and run efficiently enough to stay afloat. You know, what's really wild is just how sophisticated these companies have become. We're not just talking about tech companies anymore. They're turning into these complex energy and financial firms. You've got Riot building a facility in Texas that's planned for 1 gigawatt of power. That's the size of a nuclear power plant. Then you have companies like CleanSpark using savvy financial strategies, and the whole industry is now using complex tools like derivatives just to manage risk. This chart really paints the picture of centralization perfectly. Each of those bubbles is a miner. The higher up it is, the more miners there are of that size. The further to the right, the more computing power they control. And the pattern is just undeniable. The network is now dominated by those few big bubbles on the far right, a tiny number of players controlling a huge piece of the pie. So you're probably thinking, okay, case closed, centralization wins. But it's not actually that clear-cut. This global chess match for the single most important resource in mining, cheap power, might actually be pushing things in the other direction. And here's the paradox, right? The very thing that created these giants, that relentless hunt for lower costs, might also be the key to breaking up their concentration in just a few places. This strategy is called geographic arbitrage. So while the US is still a huge player, rising energy costs are pushing companies to look all over the world for cheaper power. We're talking about places like Paraguay with its massive hydroelectric dams, or tax-friendly countries like El Salvador, or even places like Pakistan that are looking to sell their surplus energy. The network is physically spreading out across the globe. And here's another surprise.
Some academic research suggests that as mining technology gets better and cheaper, it doesn't just help the big guys. It actually helps the smaller, less efficient miners catch up, which kind of levels the playing field and makes it harder for any one group to dominate.
But honestly, the biggest plot twist in this entire story of decentralization has almost nothing to do with geography or mining tech. It has everything to do with the completely different technology that is hungry for the exact same thing miners have mastered finding: cheap, abundant power.
Just think about it for a second. What is a big Bitcoin mine really? It's a massive data center plugged into a huge source of low-cost electricity. Well, it turns out there's another industry that is absolutely starving for that exact same infrastructure. Yep, artificial intelligence.
The numbers here are just staggering. In 2025 alone, public Bitcoin miners signed contracts worth over $65 billion to provide infrastructure for AI and high-performance computing. They are flipping their facilities to power the global AI arms race at an incredible speed.
And this quote tells you exactly why they're pivoting so fast.
The economics are just impossible to ignore. For the same electricity, they can make so much more money servicing AI clients than they can mining Bitcoin. This isn't a side hustle anymore. For a lot of them, it's quickly becoming the main business.
So what this all means is that the entire industry is reinventing itself before our eyes. These companies aren't just Bitcoin miners anymore. They're evolving into these diversified, hybrid data companies where securing the Bitcoin network is just one of the things they do.
Which brings us all the way back to where we started. But now, that original question about decentralization, it feels kind of incomplete, doesn't it? We're not just seeing consolidation anymore. What we're really witnessing is the institutionalization of the whole industry. Bitcoin mining is getting absorbed into this much bigger digital and data economy. It's becoming just one app running inside these massive hybrid data centers.
And that's the thought I really want to leave you with. The question isn't just, will mining be decentralized anymore? The new question is, what does decentralization even mean when the security of the Bitcoin network is basically being subsidized by the AI industry? If these companies are making most of their profit from AI, does that make Bitcoin stronger, or does it create a whole new kind of risk nobody saw coming? This whole pivot just reframes the entire debate and leaves us with a much more complex and honestly a much more fascinating question about what the future holds.